Now let's take a look about the trade lines. In the installment trade lines, an installment debt is a loan that is repaid by the borrower regular installment. Installment debt is generally repaid in equal monthly payment that includes interest and a portion of principal. It is a favored method of consumer financing for big ticket items such as the car or the home, which we call it the installment trade lines. Installment trade credit when determining whether you qualify for an installment loan and the interest rate that you will pay. A potential lender will look at your credit score, your annual income, and your debt to income ratio. Lenders look at your debt to income ratio to see how much you can responsibly afford to borrow in a potential installment loan. A lender may ask you a number of additional questions, including the name of your current employer and the number of years you have worked at your employer, all determining how well you are likely to manage the monthly payment of an installment loan. And even they could ask you about or ask the customer about how long they are staying in their homes, how much they are paying for the rent, if they own the home or rent. So it's all about the financial situation. The revolving trade lines are credit products that creditors can use multiple times. These accounts include credit cards and equity lines. So your credit card is a revolving trade line. So the account revolve meaning the balance fluctuate from month to month based on your usage. So for example, one month you consume 10% or let's say $100 from your credit card, the other month you consume 500 or full amount like 1000 or whatever, depends on what is your credit limit. The term trade simply means the account. The balance you owe relative to the maximum line amount. This has an impact on your overall credit score. So what are trade lines? These are the accounts listed on your credit report. What are public records? Liens, bankruptcy, and judgment. What are collection? Delinquent accounts that have been sent to third-party company to collect the money from this customer. So inquiries, what is the inquiry? When you apply for a new credit, this will be an inquiry. There are two, the soft inquiry and the hard inquiry. What is soft inquiry? It's called non-credit inquiry. This is when you order your credit report to request any change. This could also be an existing creditor checking to see if you qualify for a higher limit or any promotion that you have to offer. It could be a landlord checking to see what kind of situation you have. A hard inquiry will affect your credit score, normally anywhere between 3 to 30 points per inquiry. That means a hard inquiry will reduce your credit score. And a soft inquiry will not affect your credit score. When a soft inquiry happens on your credit report, you can only view the basic information. Is your credit score excellent, good, or fair and poor? But you can see more details about your report. So your question is, what is the difference between the two types of trade lines?